Good morning and welcome to Stock Market Today. It's Monday, December 17th, 2018, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can follow me on Twitter. I'm at Dan Russo _CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. And if you head over to www.chaikinanalytics.com/today, you can sign up to receive a free email every day, stock ideas, and you'll be able to follow along with this show. So I hope everybody had a great weekend. Heading into the final 2 weeks of the year here, just to kind of recap Friday, U.S. equities were lower. Major indexes finished just off the worst levels of the day. Healthcare was the biggest decliner. That was on the back of that news out of Johnson & Johnson. Tech and energy were also laggards. Bond proxies, lead, materials, and financials were also relative outperformers. Treasuries were firmer across the curve. The dollar was strongest against the euro and sterling, and weaker on that yen cross. Gold off about 0.5%. WTI crude settled down 2.6%. So your outperformers, as I said, REITs and utilities, materials, comm services, and fins. Your underperformers, healthcare down big, tech, energy, and consumer discretionary. And as we arrive at the desk this morning, futures are a little changed after coming under pressure for a second straight week last week. We've actually been down in 4 of the past 5 weeks. All 3 major indexes slumping into correction territory for the first time since March of 16. Asian markets were higher overnight. Europe mostly lower here today. Treasuries unchanged to a bit stronger. Dollar is lower on the major crosses. Gold up 20 bips. WTI crude is up almost 1%. And as we look at the S&P 500 structure, you can see we're going to start the week right at support around 2,600. It's really a support zone, though, 2,570 to 2,600. Resistance now comes into play at 2,700, then at the declining 200-day moving average, 2,756, and then that interim high near 2815 is the key level for the bulls to regain. RSI remains in bearish ranges, now once again heading lower. We will, and actually what's interesting is if we drew this line here, you could see that this slight uptrend of higher lows for the RSI has been broken. Chaikin money flow remains bullish, but kind of moving back towards the even line. So we'll see if that can hold above. It's interesting, for all the movement and all the chatter, we're still in the range. We are still in this well-defined trading range. All indications point to the trend moving lower, the defensive posture of the market, as well as some of the other indicators that we look at. But right now, we're still in the range. We're holding support, but the key level for the bulls remains that 2815 mark. So you're marking in a minute if you're following along in that email at home. S&P 500 starts the week near support at 2,600. We hit that already. Small caps underperformance is intensifying. 10-year yield remains below the 200-day moving average. Flight to safety giving a bid to bonds. Commodity weakness persists. I think that's a function of global growth slowing down. Futures point to a flat open. Power bars for the major indexes all skewed to the bearish side. Dow 2 to 4. S&P 500 down 1.8% yesterday. 41 bulls for 114 bears. That was on Friday, rather. NASDAQ, big underperformer, down 2.5%. 11 bullish or very bullish stocks, 24 bearish or very bearish stock. Small caps actually had a day of outperformance, but on the week, their underperformance really intensified. And look at the power bar ratios here. 132 bullish or very bullish stocks, 487 bearish or very bearish stocks. Flight to quality sends the price of bonds higher, taking the yield lower. According to the Chaikin Power Bar, small cap stocks and large cap stocks remain bearish. Major indexes all remain bearish. Our stock of the day is Exelixis, EXEL, close at 2103, down 1.22% on Friday. Has a very bullish Chaikin power gauge rating due to very strong earnings performance, very strong price volume activity, attractive financial metrics. There is some negative expert activity here, but this is kind of an interesting name to me. You know, I like to try to identify trends and changes of trends as soon as possible and look for opportunities to get on board. And EXEL kind of starts to meet that criteria. Very bullish stock, strong trend, weak industry. We've talked about the drugs. You know, The larger cap drug names have been strong. Smaller caps have been under pressure. But there seems to really be a personality change going on here with EXEL, Exelixis. Ribbon at the bottom of the screen, you can see neutral and bearish earlier this year, and then a long reading of neutral until turning bullish in the November timeframe. Shortly thereafter, after a long string of underperformance, the stock begins to outperform relative to the S&P 500. The Chaikin money flow, look at the character change here. Persistent bullish money flow as the stock was being sold throughout the majority of 2018. Now all of a sudden, look at this peak in bullish money flow as the stock gapped higher following earnings and has really started to become accumulated here, testing resistance in the $20 to $22 range above the rising long-term trend line and about to become oversold. This is an interesting name to me. I'm going to dig in on it a little bit further. I would like to see a little bit more of an oversold reading. I'd like to see us, again, with the market choppy and having a bearish leaning, we can pick our spots and set up better tactical setups. The other aspect is that what I always talk about when we're talking about drug stocks and biotech stocks is we want to be aware of what's coming down the pipeline. We don't want to be burned by a news event that could send the stock much lower if we're considering it as a long idea here, which we should be considering it as a long idea. I'm going to add it to a bullish watch list, do some reading on the name, see what the pipeline looks like, but all signs point to a personality change here for Exelixis, EXEL. We're going to add it to a bullish watch list here today. Turning now to our sector tracker, movement of the major sectors over the last 5 days, we can see that utilities remain at the top of the list where they have been for quite some time, as well as the communications group. Communications now has some offensive properties, but still has a lot of the big defensive names in there. Tech in the top 3, we do like to see that. So are staples. Financials just continue to come under pressure with the narrowing of the yield curve. Energy, oil prices weighing there. Healthcare, big underperformer on Friday, moves that stock and moves that sector into the bottom 3 on the back of that news of Johnson & Johnson disclosing that there's been asbestos in their Johnson's talc for decades, and that's just not news you want to see or hear as a Johnson & Johnson shareholder. Middle of the pack, discretionary materials and industrials. We'll look for real estate to kind of regain its footing here a bit if rates do continue to move lower. Turning now to our industry in focus. The industry in focus is transportation services, which again speaks to some of the growth concerns that we're having out there. In a booming economy or in an economy where investors weren't concerned about growth slowing down, you'd expect to see transportation companies doing well, and they just aren't. Over the past 6 months, the transportation subsector has underperformed the S&P 500 by 8.92%. And its power bar ratio, which measures future potential, is very weak, with more bearish than bullish stocks. It's currently ranked number 18 of 21 subsectors and has moved down 8 slots over the past week. And we can see here, no bullish or very bullish stocks, 9 bearish or very bearish stocks. And some of those indicative bearish and very bearish stocks are Kirby Corp, KEX, Avis Budget, CAR, and United Pacific. Now, Kirby is very bearish. CAR and UNP are both bearish. Let's take a look at Kirby here. We've looked at this one in the past. To be honest, I think it is still the best setup for a potential bearish idea, just not now. Very bearish, namely trend weak industry group. So we know we're fishing in the right pond. Type of name that at the very least we don't want to own. And if we are aggressive to the bearish side, we want to look for opportunities to enter trades to the bearish side of the coin, either shorting the stock, buying put options, vertical put spreads, however you choose to express your view. But here's why. We've been very bearish or bearish since July. Market and model in agreement pretty much since that time frame as well. Intensity of underperformance actually increasing here. So market and model are in agreement. Dynamic duo in gear. And really for the back half, predominantly since the top here around $95 back in June, money flow has been persistently bearish. Look at how the troughs in money flow are deep and they last a long time, while the peaks in bullish money flow tend to be shallow and short-lived. Stock is in a pronounced downtrend below the falling long-term trend line. Only issue I have here is that the stock is currently oversold. So we want to look for a rally back to kind of the $73 to $75 level to produce an overbought condition, which sets up an opportunity to enter the trade to the bearish side. Add KEX to your bearish watch list today. I think that it's a name that you don't want to own it if you're long. You want to look for an opportunity to get out. And if you want to be opportunistic and take advantage of further weakness, I think you'll get a setup with the next overbought reading in the stock. So turning now to what's trending. Friday's S&P 500 movers and shakers. Scana SCG up 6.3% as there was support for Dominion's bid. Looks like that deal is likely to go through. Sealed Air, bearish stock up 4.75%, catches an upgrade. PSA rebounded, caught a downgrade on Thursday. Stock was down hard, rebounded a bit on Friday. IRM up nearly 2%. Don't see any real news there. Same with Royal Caribbean. Don't see any real news there. Johnson & Johnson down 10%. We've talked about it already. Asbestos in there. Johnny John Talc. That is just bad news. Costco down hard following their earnings announcement. Retail names continue to come under pressure. UHS and HCA. UHS caught a downgrade, and HCA is a services. Both names are healthcare services, going to come under pressure. Texas judge ruling that the Affordable Care Act, Obamacare, is unconstitutional. We'll see how that plays out, but services names did come under pressure. Adobe down over 7% following their earnings. So small cap underperformance intensifies. What do I mean by that? Our relative strength against the SPY, our proprietary measure of relative strength, trading near the lows. IWM has a neutral Chaikin Power Gauge ETF rating, but it did break down on Friday. Actually is now broken below the January lows. Money flow is bearish. Fund is oversold, but what I'm concerned with is this underperformance continues to underperform, not really seeing any support building for small caps on a relative basis. The 10-year yield remains under pressure. Flight to quality has led investors to treasuries, and we're seeing that manifested in lower yields for the 10-year. You can see here below the 50-day moving average, which is declining, below the 200-day moving average, which is moving from rising to flat. What's interesting to me is that this peak here at around 3.23% was met with a massive negative divergence in RSI. RSI has now actually become deeply oversold, trying to rally out of that oversold position, but I think that we're going to have a hard time seeing yields move much higher from here. Resistance at 2.9, then 3, and then 3.09. We do have support around the 2.8% level. I just think we're going to see some choppy range-bound trade. Remember, the Fed is due to give us an interest rate announcement this week. All indications are that they are going to raise rates 25 basis points, but everybody's going to be listening for commentary following that announcement to see if there is a dovish or a hawkish turn. Commodity weakness persists. This is predominantly due to the price of oil, but as we look at the CRB commodity continuous commodity index, we can see we're just breaking down again. Below the 50, below the 200-day. RSI middle of the ranges here, so not really tipping its hand one way or the other, but I think that persistent commodity weakness, and in particular oil, is having an impact on the materials sector. Here's the XLB. You can see the breakdown through 56. A couple of retests have failed. Below the 50-day moving average, below the 200-day moving average. RSI for the XLB, that's the Material Select Sector ETF, is in bearish ranges. And when we look at relative performance, XLB against the SPY, pretty clear that we're in a downtrend here. So as this chart continues to struggle and potentially move lower, we would expect this chart to worsen, and that does seem to be the case. Now, there is some support around the $50 level for the XLB, so we'll see how we react there. But it's hard to get excited about the group, especially when in Chaikin Analytics, zero, count them, none of the names in the materials sector have a bullish or very bullish Chaikin Power Gauge rating. So that's it for today. Sign up for Power Feed email. Head over to chaikinanalytics.com/today. daily stock ideas. Follow along with this show. And if you like what you're hearing, share our link on social media. We'll see you tomorrow.